And I'm going to do a very hard transition here to talk about the real estate industry. Of course, we're the business network, so we want to get on with the markets and that. So investing in multifamily apartments has really been a bright spot during the housing downturn. But our next guest says that could be changing. John Levy is president of John B. Levy and Company, which is a real estate investment banking firm. John, it's great to see you back on the show.
Nice to see you, Lori.
So today we're talking about multifamily homes, which have really, to put to your words, have been the rage. But you say that's changing now. Why is that?
Yeah, I think we're getting close to the top. I mean, trees don't grow to the sky, and we've really had a run in multifamily, primarily because single family has been so bad, and single family's still in the tank. But you know, in another year or so, I think we're going to be telling a different story.
So is it more about topping out on the multifamily side or bottoming on the single family side?
Well, actually, they're related because as single family gets better, people move out of their apartments. They say, I can buy a house now. Prices have bottomed out. They're going up. They want to get a mortgage, and maybe they'll be able to qualify for it. So, yeah, I think they're really related. It's kind of like the brake in the gas.
What about the role of Fannie and Freddie and the government-sponsored entities in the multifamily side? Because as they offer these cheaper loans, I mean, some might argue that the pricing for multifamily for these rents has been distorted because of all the other benefits that renters have enjoyed in recent years.
Yeah, I'm not sure the pricing for the rents have been distorted because the rents are really a market factor. But what has been distorted is the price for mortgages, because Fannie and Freddie put out probably 50 or 60% of the multifamily mortgages in the country, and yet we think that they're a half percentage point below the market. And that was probably okay in 08 or 09 when we were trying to get credit into the market. But right now you have to wonder, why would they underprice a bank, a life company, a pension fund, especially when they're trying to make money to feed the losses which they have in single family?
I'll tell you, it's a little even more infuriating when you learn today there's a headline that Fannie regulators have come to Treasury now asking for another $4.6 billion to cover continuing losses. I know that's on the single family side, but it just kind of raises the question of what role these GSEs should be playing in our housing market. And, you know, I know you're looking at this from a real estate investment trust, from an outside investor's perspective, but really, what should their role be in significantly, meaningfully boosting and improving the health of the housing market overall?
Well, it's funny. I always thought that Fannie and Freddie's real role should be in low-income housing because there isn't a third-party market for low-income housing. But there is a third-party market, a private market, for nice luxury apartments, for B-grade apartments. And I'm not sure what they're doing really controlling the market and controlling from a price point of view. As I said, it made perfect sense to me in 08, 09, when there really was no credit for housing anywhere. But now, in 11 and in 12, there is credit. So it seems like to me that somebody's going to say it's now time for you not to be as big a force in the multifamily housing business.
So let's make this actionable, John. If you're looking to invest, you're telling me the top tier markets, these so-called gateway cities, the major cities, are perhaps topping out now, but there might be some opportunity to invest in some medium-level cities in the rental market.
Yeah, I think that for example, in the upper Midwest, we like that because it hasn't been picked over. We like some of the smaller second and third tier cities. But in the big cities, in New York, I mean, you know how tough it is to get an apartment here. It's almost impossible. Boston's been picked over. Washington's been picked over. San Francisco. So I think if you're going to be buying now, you've got to buy in a smaller city. The gateway cities, the 24-hour cities that the foreigners know, any bargains that were here are long gone. You
watching interest rates at all?
No, I'm not too worried about that. I think they are going to go up right now. I mean, the Bernanke policy is working, whether we like it or not. He's keeping short-term rates very, very low. And what that does is that's saying there's a real price for you to park your money. You've got to drive. And when you drive your money, you have to invest. So that's really helped real estate. I'm not concerned that we're going to have a real spike in interest rates, certainly not anytime soon.
What about, what's your status on office, retail, warehouse space? Any potential there?
Yeah, I think actually the hot market, at least, hot probably the wrong term, but the up-and-coming market is probably hotels, which is a little bit of a surprise. As business does well, people travel more. And when they travel well, hotels can raise their rates every night as opposed to office buildings where they may not get a chance to raise their rate but every 5 or 10 years. So we actually like hotels in the right markets.
All right, some ideas there for you from John Levy. Thanks so much for coming in.
Lori, my pleasure.